We were supposed to go for a drink tonight. Why aren't they calling yet? So Chad can't come? What about Zoomer?
Sorry, busy tonight. Can't come.
What are you guys doing? Why can't you meet with me?
We are going out of the country to celebrate our crypto gains.
You trade? I thought you owned a business.
I do, but I joined Crypto Gains.
What's that?
It's a crypto community where they give you access to free lessons over trading and also trading alerts. My portfolio has outperformed Bitcoin for the year. Make sure to join the Discord community in the link below.
Since you are a novice, watch all the great trading educational videos first.
Okay. Alright, first lesson. Can't wait to get started.
Let's start with Candlestick Fundamentals. Now, starting off with how to read a candlestick. On the left, we have a bullish candle because price increased and went higher. On the right, we have a bearish candle because price decreased and went lower. This area outlined is known as the body or range. The lines on the end of the body of the candles are known as the wicks or tails. As you see here, these candles have a lower and upper wick. For bullish candles, the opening price occurs at the bottom of the body, as you see here. Closing price is at the top of the body. And for bearish candles, it's the opposite. The opening price occurs at the top of the body, and the closing price occurs at the bottom of the body. The top of the upper wicks represent the highest price of the candlestick, and the bottom of the lower wicks represent the lowest price of the candlestick. Alright, now I'm going to show you a visual guide to how candlesticks are formed. As candlesticks are formed, they tell us a message. When you have a candlestick with no wicks and only a large body, it shows a really strong sentiment in the market. It's showing control. In this case, because the candle is green, it's showing there's a lot of demand from buyers. Now, as the candle continues to form, it shows sellers stepping into the market and bringing the price down just a little just before the candle closes. Overall, the large green body tells us that buyers are in control. Now let's look at another example. The candlestick starts forming, prices start rising high, but sellers come into the market strong this time and pull the price back down. A small green body is formed, created from the big price rejection. The small candle closes, the small green body tells us buyers are able to control the price, but just barely, showing some weakness in the strength of their ability to control the price. Now I'm going to go over another example visually to how candles are formed, but this time it's going to be over some bearish candles. Here's our next example. The candle starts forming, showing buyers stepping into the market and pushing price up, gaining a lot of momentum. Only then for the sellers to step in and bring the price all the way back to where the candle initially opened and then even lower past that, and the candle closes. We see a small body, but a strong price retracement caused by the sellers themselves. This candle tells us sellers are maintaining control, but just bit by bit. Now let's look at one more example. The candlestick starts forming, buyers step into the market initially once again, but they are weak. Sellers come into the market and bring price very low. At the bottom, we see a wick showing buyers pushing up the price right before the candle closes. This candle from the sides of the body shows us sellers are strong and in control of the current price action. Alright, now that you better understand candlestick fundamentals and how candlesticks are formed, I'm going to cover some candlestick patterns. The first pattern we're going to cover is the engulfing candle. It's where the current candle is a different color from the previous candle and it engulfs it. Here we have a bullish engulfing candle. Now a candle is technically considered, keyword technically considered, an engulfing candle when the opening and closing covers both the body and the wicks of the previous candle. Now as we can see here by these lines being drawn right now, the body is not engulfing the entire candle. Now, that's because we have the opening of the body right here, where this line is being drawn out, but the closing of the body is right here, where the line is not being drawn out. If the line is being drawn here, it would show that this entire candle is not being engulfed. But typically for the majority of traders, it's the body-to-body coverage that's considered most important. As long as the current candle's body fully engulfs the body of the previous candle, then it's considered an engulfing candle. Now, the wicks of the previous candle can extend beyond the highs and lows, as we see here, of the body's candle without negating the engulfing pattern. Engulfing candles are popular because they're good for predicting reversals in the markets with accuracy. Now I'll show you an example of an engulfing candle on the charts. All right, we're on TradingView. For this example, I'm going to be using this platform to showcase it. But first off, there's a few things you need to understand. This here is the asset we're looking at, Ethereum. This refers to the time frame, and 1D stands for a one-day time frame. Each candlestick on the chart represents the price action and movement over 1 day of time. If we were to change to the 4-hour time interval, it would display as 4H, and each candlestick would symbolize a 4-hour time interval. This bar below tells us the day and time, which displays the date as Tuesday, 5th, December 23rd for this specific candle. Now, if we were to move one candle to the right, each step represents a 4-hour increment and so on. As you can see, the time changing at the bottom. And vice versa, if we were to go to this candle again but go backwards, we would see a 4-hour decrease in the time interval. Now, if you wanted to check the closing price of an opening candle, let's say like this candle, for example, we'd go over here to our tools and we'd select cross, and then we'd go to the opening of the candle, and the dashed line to the right would show that we're roughly at a price of $2,231, which means that was the price when the candlestick opened. Now, if we wanted to look at when it closed, we'd go up and hover to where it closed, and price shows $2,273. All right, now I'm going to go over our bullish engulfing candle example. I'm going to zoom out here. And it looks like we have an ascending triangle. Now, I'm going to connect the lows and the highs of the channel to make things more clear. To make a good connection point, I'm going to use the line view versus the current candle view. So if you go here, we can see we have the candle view selected. I'm going to select the line view. What this is going to do is show the current price in the form of a line. Then I'm going to go over to the tools and I'm going to select our lines. I'm going to select the ray. A ray is pretty much going to create an ever continuing line in the direction you want it to. So we're going to click down here for our connection point for the support level. Want to get the beginning of that really sharp. Next, I'm going to have the next connection point form right about here. Then I'm going to copy and paste this ray. So I've pretty much made a duplicate version of this current ray right here. And what this is going to do is it's giving us a second ray with the exact same angle, which pretty much gives us a really good chance at getting this channel looking as good as it can and be as accurate as it can. So I'm going to have the top of this channel be right here. Now we're going to go back to the candle view, and we can clearly see we have a ascending channel, which means price is ascending or going up in this channel. Now, I'm going to go over the bullish engulfing example for that candle pattern. All right, so we see at this candle right here that we have a bullish engulfing candle. We can confirm that because of two things. One, the previous candle is opposite, it's red, and 2, the current candle is green and its body engulfs the previous red candle. What do we see shortly after that? We see a reversal in price followed by a second bullish engulfing candle. Again, confirmed by 2 things. 1, the previous body or candle is opposite, it's red, and 2, our current candle, which is green, has a body that engulfs the previous body's candle. And what do we see? We see a continuation, a strong continuation in price for that price reversal. Now, this is a good example for a bullish engulfing candle pattern, but it's not a good example of a trade setup off of this candle pattern. And the reason that is because even though we have these amazing 2 bullish engulfing candles on the 4-hour time frame, we don't have the channel to use as a confirmation to give us a further high probability of the trade going in our favor. And the reason that is because at this point in time, we don't know of this channel yet because price hasn't developed or had time to play out. So if I bring our entire channel into view here, that example I showed you is all the way over here. It's not until at this point in time when, in my opinion, the channel can be created. And so for the channel to be created, we need 2 things. We need a valid support level and a valid resistance level. Well, for the support level, we have a test here. We have a second test here, followed by a third test, some consolidation, followed by a fourth test or a breakout, a false breakout because price breaks up and then retraces back into the channel. So we clearly have a support level here for the channel. Now for the resistance level for the channel, we have a couple breakouts here, a third breakout followed by some consolidation, and then almost a fourth touch right here, followed by, a retracement back down to the bottom of the channel. So at this time, we would have been able to form this channel. All right, and once this channel is formed, it gives us room to use as a potential confirmation for a future trade setup. Now, I'm going to cover bearish engulfing candle example. Now, this candle we see right here, it is not only a good example for a bearish engulfing candle pattern, but it's also a good example to use as a trade setup using a bearish engulfing candle. Now, first thing, we confirm it's a bearish engulfing candle because the previous candle is opposite, it's green, and the body of the current candle is bigger than the candle before it. Now, we can also see that the candle comes above our channel past the resistance zone, but then sellers come in and not only push the price back down, but a good amount back down, forming this bearish engulfing candle. Because of this, it's a second confirmation in when combined with the channel. So this is a good trade setup. I would use a couple more confirmations, but to keep things simple, since this is literally the first video in this free course, I'm gonna just stick with that. Now we can come over here to these tools and we can come over here to short position. And let's say we get in right around the top of the channel. We open up a short position. And let's say we set a max 2% loss, because that's what I recommend in my risk management video. And let's say we set a target to about the bottom of the channel. That would set us up for a trade with a risk reward ratio of 3.31, meaning for every dollar we risked, we would make in return $3.31 if the trade went in our favor. And if it didn't go in our favor and hit our stop loss, we would then lose 2% of our position size. So if this trade was to play out, we'd see that it actually go pretty well. You see reverse in price, and we actually come all the way back down to the bottom of the channel. Now, I want to make a note that it's important to know that just because there's a bullish or bearish engulfing candle like this one, it does not mean or guarantee a price reversal on every occasion. To make well-informed trading decisions, you want to combine candlestick patterns with additional tools such as support and resistance levels, indicators, various strategies, and other analysis methods. It's the combination of using them all together that gives you a high probability trade setup. Not doing this is literally like trading blindfolded.
Meanwhile,
and other analysis methods. It's the combination of using them all together that gives you a high probability trade setup. Not doing this.
Wow, this video is really good. Everything is presented so clearly and is simple to understand. I'm feeling good about understanding candlesticks and think I am ready to trade and get this crypto. Wait, I am not even halfway through the first lesson.
Since you are a novice, watch all the great trading educational videos.
Nah, I got this. I'm such a genius.
Wait a minute!
a few moments later.
What went wrong? I'm such a loser. How could this happen?
We are having so much fun in Sweden. I love being a winner.
No way, I can't quit. Gotta give it my all.
The next candlestick pattern we have is going to be the Doji Candle. It looks like a plus sign and has no body. As you can see here, the body is very minimal and the wicks are long. Now this is how the Doji Candle is formed. Candle opens, buyers push the price up, only for then sellers to come in, push price back down to where the candle nearly opened, and then they're going to continue applying pressure and push the price down lower, but then buyers step in and push the price back up nearly to where the candle originally opened. We're going to end up with a figure that looks like a plus sign, and this is the Doji Candle. Now, the Doji Candle is a neutral candlestick pattern that traders use to determine when price is going to reverse in a direction. Now, we have different type of Doji candlestick patterns. The first one we're going to have is the one I just went over, which is known as the regular Doji. Now, the regular Doji just shows indecision from both buyers and sellers. The second type of Doji candlestick pattern we're going to have is the long-legged Doji. The only difference with this candlestick is that the body closed a little higher or it closes a little lower versus closing nearly in the center. And we end up with one side of the wicks being low and the other wick being very long. The third type of Doji candlestick pattern we have is going to be the Dragonfly Doji. Now, the Dragonfly Doji shows that initially sellers drive the price lower, but by the end of the session, buyers take control and they drive the price back up to where the candle opened. So, price ends up where it started, just as these candles did, except it shows rejection from lower prices. It shows buyers pushing the price up. Now, the fourth candlestick pattern we have for dojis are going to be the Gravestone Doji. Now, the Gravestone Doji shows that candle opens and the buyers push price higher, but by the end of the session, sellers take control and drive price back down to where the candle opened. Same thing as all the other candles, price nearly ends up where it started. The gravestone doji shows rejection from higher prices. Now, all of these doji candlestick patterns indicate the same thing, which is a potential reversal in price. Now, I'll go over an example using a doji candlestick pattern for a trade setup. For this doji candle example, I'm going to be using the same ascending trend line I used earlier. Now, I see right now 2 bearish long-legged dojis followed by a small bearish candle. I also see that we have a resistance level, so I'm going to come over to my trend line tool and draw a trend line. We are going to put this right about there. Yeah, like that. I'm going to copy and paste this. And also mark the resistance level. Do that. All right, yeah, I like that. All right, so we can see right now that price has risen up here into this range and is ranging. You can also see that we clearly have a resistance level, as you can see here, that every time price has broken through this resistance level, buyers have stepped in the majority of the time and pushed the price right back up. That's why we have all these wicks. Now, with dojis, we know that they represent the market is uncertain on which way the market wants to move. We also have the resistance. Whenever the market is uncertain at a certain price level along with resistance, the price more than often than not heads in the opposite direction. At this point, it's showing us that sellers, to me, is starting to get a little less confident, and buyers are starting to enter the market. As we see at the beginning of this range, sellers were able to break the level, but buyers kept pushing us back into the range. Over here towards the end, sellers are not even breaking it. Still though, at this point in time, I would not feel confident using these doji candle patterns for a trade setup. But what we can do is look at the candles on the larger time frames, because we know that on the larger time frames, the candles don't lie. They tell facts in the charts and what's happening. So if we go to the daily, we see here that we have a lot of bullish candles that have created a lot of action in the price moving up. And we see also in this range that a lot of these candles are bullish. We also see that we have a large bearish engulfing candle right here. But it doesn't matter, because then the next day when this daily candle opens right here, price comes down, sellers try to, a lot of sellers probably see this bearish candle and use that as a confirmation to enter the market and sell. But as they bring the price down, buyers once again step in and say, no, that's not going to happen. And they defend this resistance level and bring the price all the way back up here, past more than 50% of this bearish engulfing candle. So that's bullish. And then if we go on the weekly time frame, we can see here that we have 3 bullish candles, and we can see that from Ethereum's low to its high has risen nearly 24% in a matter of only 3 weeks. So there's a lot of bullish sentiment in the market. So when we combine all that, we can say more than likely the price is going to continue moving upward. But is it at this point in time? I personally wouldn't feel confident using this as a trade setup. I'd want a couple more confirmations. I'd want to look at my fibs and also the order flow. But that's a lot more advanced, so I'm not going to go there. But if I had to pick which way the price is going to move at this point in time, I would say up based on everything we've gone over. So we play this out. We can see that price continues to go up. And also, we see as we broke out of this range, we broke the resistance level. We came back and tested the resistance level there, then and there, turning it into support before the price continued to move up. This is literally like technical analysis 101. All right, the next candle pattern I'm going to go over are hammer candles. All right, the next candlestick pattern we have is the hammer candle. The hammer pattern is a bullish reversal pattern that can be spotted at the end of a downtrend. Now, typically one of the characteristics of the hammer candle is that the opening price, the closing price, and the peak price point are approximately the same. So we have here the opening, the closing of the candle, and then the peak price about the same level. On the right, we have a bearish hammer candle forming. It also has the same characteristics where the closing, the opening, and the peak price is about the same level. And then another characteristics that the hammer candle has is that it'll have a long wick. And this long wick, it's suggested that it should be twice the length of the small body. And then they have little to no upper wicks. The next type of hammer candle we have is the inverted hammer candle. It's exactly what the name itself suggests, hammer turned upside down. This pattern also occurs at the bottom of a downtrend. Again, it has the same characteristics for both the bullish and bearish inverted hammer candle, where you have the opening and the closing of the body this time be closest to the lowest price point of the candle, just like this. And then both of these candles have also little to no lower tail. And then they have a long upper wick. Again, that should be twice the length of the body. Now, the hammer and inverted hammer candlestick pattern are amongst the most popular trading formations when it comes to candlestick patterns. Both are reversal patterns and they occur at the bottom of a downtrend. Both of these hammers are considered to favor a price move up. All right, so here we have a hammer setup. So as we can see here, we have a downtrend, and then we have a doji candle and a bullish hammer that's formed near the bottom of this downtrend. And we know this because this green area symbolizes a supply zone, and we can see that as price dips into the supply zone area, that buyers are aggressively stepping in and pushing the price back up. So in this scenario, more often than not, we would have a reversal. And on the right, we have an inverted hammer setup. So we see also that we have a downtrend, and then we have a bearish inverted hammer followed by a bullish inverted hammer that is formed right on top of a resistance level. So in this scenario also, more often than not, we would get a reversal in price. All right, the last single candlestick pattern we're going to cover is the shooting star pattern. It's a bearish reversal pattern that's found traditionally at the top of an upward trend when the trend is losing its momentum. Here we can see we have a bullish shooting star pattern forming. Now the shooting star pretty much looks like a hammer candle turned upside down, very much like the inverted hammer pattern, where the open of the candle and the close of the candle and the low price are pretty much at the bottom of the candle. Now we have a bearish shooting star pattern forming. Now both the green and red version, the bullish and bearish shooting star pattern, pretty much indicate a lower price move. The red candle, the bearish one, is a little bit more powerful given that the close is at the bottom of the candle. signifying sellers are even in more control for this shooting star pattern versus the bullish shooting star pattern. And then similar to the hammer candle as well, the teller wick should be twice the length of the body. Alright, now I'm going to break down an example of the shooting star pattern. Alright, we have our shooting star pattern. Alright, we can see that we have an upward trend here, followed by our shooting star at the top of the trend. So we would expect price to reverse and go down. Now, again, the reason that this shooting star is not an inverted hammer candle is because an inverted hammer candle would only be found at the bottom of a downward trend. We're at the top of an upward trend, and that's why this is a shooting star and not an inverted hammer candle. Alright, the next candlestick pattern we have is the momentum candle. Now, a momentum candle is characterized by a long body and either a short wick or no wick at all. It's pretty much one big candlestick, like we see here, with a lot of volume. Now, for me personally, to validate a momentum candle, I would have to see that the candle is 2 to 3 times bigger than the candles preceding it or the candles before it. As we see here, this candle is like 4 to 5 times larger than this candle. The other thing I'd want to check is volume. And then the third thing is that if the candle is breaking past a key support or resistance level, I want to see if that candle closes above it, and if it does, how far past the support or resistance level does it close. Now on the right, we have an example of a bearish momentum candle. And this is pretty much just a long bearish candle with no wick, which suggests sellers have the upper hand, and vice versa on the bullish side, just indicates that buyers have taken control of the market. This is personally one of my favorite candles when it comes to trading, especially when they occur on the daily or weekly time frame, because those time frames can be very powerful. Now I'm going to go over an example of a trade setup using the momentum candle. Alright, for this momentum candle, we are on the charts and Bitcoin is our asset. Now we see here we have our momentum candle right here. But first off, I want to cover a couple things. I have labeled out a supply zone level right here, and I've laid out a demand zone area right here. Now, all a supply zone is where aggressive selling occurs, and for a demand zone, it's where aggressive buying occurs. So as we can see here, as price raises into the zone, aggressive selling occurs, and so on here, and vice versa for demand zone. When the price reaches into the demand zone, price gets pushed up because buyers are aggressively buying. Now I'm going to go over to the weekly time frame. Now on the weekly time frame, we can see this is even more clear. As price is rising into the supply zone, sellers are stepping in aggressively and pushing the price down. That's why we see all these wicks. And in the demand zone, when price is going into this zone, buyers are buying up the market, and that's why we see all these wicks down here. Now I'm going to go back to my daily time frame. Alright, we are back on the daily time frame. We have a momentum candle right here. I want to point out a few things. So the first thing is, we see that the momentum candle clearly breaks past the resistance and supply zone, and it closes far above it. So we have our resistance level here at the bottom. If I click the line view, you can see that at the bottom of the supply zone, we also have our resistance level. And then we can see that the supply zone is being shattered by this candle. And the most important thing is the body of the candle closes a good distance above it. So we have that. The next thing we want to look at is that for the body of the momentum candle, how much larger is it than the candles preceding the breakout? So we can see that this momentum candle, its body is literally 3 to 4 times the size of the candles preceding its breakout. So it's pretty clear to say that this is a momentum candle, and most likely price is going to continue moving forward. So if we play that out, we see that that is the case here. Now, you might be asking yourself, what could cause such a volatile and strong candle to occur? Well, it's pretty much a market maker coming in and taking a lot of liquidity. So when this move happened so strong, trading is a zero-sum game. So on the opposite end of this move, there were a lot of sellers providing liquidity. And if we look at here, that this trade occurred on 23rd of October, I'll go over here to CoinGlass, and I'm looking at the BTC total liquidations chart. So this information is pretty much some public data. So as we know, Bitcoin is operated on a public ledger and it's an open source network. So the majority of trading information is public knowledge. Now, if we go here on the 22nd, we can see that $161 million of liquidations occurred, short liquidations, meaning that these short sellers got margin called and lost 100% of their position size. This is at 1900 hours, so this is about 4 to 5 hours before midnight. So shortly, the next day starts, and an additional 68 million of short liquidations occurs. So roughly, we had about 220 million short liquidations, meaning that a lot of liquidity was taken by a market maker. For this to happen, you've had to have a lot of market participants doing a few things. 3 things to be specific. So I'm going to label these 3 things as 3 types of traders. So the first trader, we're going to refer to him as the no stop loss guy. So this guy has entered a short position or sell position, and price is rising, and it eventually gets to his stop loss, which he might have set right above this resistance level. So as that price level reaches, his stop loss is hit, and then he's forced to close his trade. So in order to close his trade, since he's selling, he has to buy back his contract. When he buys back the contract, it pushes the price up even more. So we have him. And then the second guy we're going to refer to as Mr. Liquidation. One second here. All right. So Mr. Liquidation most likely opened up some sell positions close to the support level or the lower demand zone area because he didn't know what he was doing. As price continued to move up, he was probably hoping the price would pull back here or here or here, but it doesn't. Price keeps moving up, and he gets to the point of no return where he's fully committed to losing 100% of his position. He's holding on to his hopes and dreams that the price is going to miraculously pull back to where he opened his trade, or even go past that where he's in profit. But that's not going to happen. Price is going to hit his margin call, and liquidations are going to occur, and that's going to push up the price very aggressively. And that was the case for the majority of this candle, because we know from the data I just looked at that $220 million worth of short liquidations occurred. And we're also going to have one more guy that we're going to refer to as the mover. So our third trader, he started out in the same scenario as this guy here that set a stop loss here. But as price rose and he got close to hitting his stop loss, he panicked and moved the stop loss, let's say here. And then once price continued to move, he moved even higher to the point to where the momentum and volatility of the candle was way too strong, and it hit his stop loss because he didn't have time to move it, or he moved the stop loss all the way up right before his liquidation level, and it forced him to close out the trade. So all these types of traders provided all this liquidity for the market maker to come in and exploit them, take the liquidity, and then continue to move price up. All right, here we have multi-candlestick patterns. So this is where we're combining 2 or more candles to form a pattern. The first one we're going to be covering is the Twizzer. We have what we call a Twizzer bottom. Twizzer bottom is where we have a bearish candle followed by a bullish candle and a downward trend, and we have buying pressure occurring pretty aggressively. And we have a tweezer top. It's the same thing flipped around. It's where we have a bullish candle followed by a reddish candle that's near the top of an upward trend, and you have aggressive selling occurring. These are both reversal patterns. So for the tweezer bottom example, we've added a demand zone here, reinforcing the idea for this trade setup playing out and price reversing. For the tweezer top example, we've added in a supply zone, same thing to reinforce the trade setup to most likely play out with price reversing. All right, the next multi-candlestick pattern we have is the 3 black crows pattern. It's a bearish reversal candlestick pattern that consists of having 3 consecutive, relatively long bearish candlesticks that occur during an uptrend, as we see here. Now, for the 3 black crows pattern to be validated, each candle opening should be lower than the previous one. So this one's lower than this one, this one's lower than this one, so that's good. Now, it's not enough for 3 bearish candles to occur in a row. We also want to make sure that the upper wicks are less than or equal to the size of their bodies. So as we see here, all these wicks are equal to or a lot smaller than the size of these bodies. Next, I'm going to go over trade setup for this pattern. All right, for the 3 black crows pattern trade setup, we're on the Bitcoin chart on the 4-hour time frame. Now you can see that we are in a large downtrend, and we can see that we have a small uptrend within the large downtrend. And then preceding the small uptrend, we have our 3 black crows that have formed. So you can see that each candle opening is lower than the preceding opening. We can also see that the wicks are equal to or smaller than the size of the bodies of the candles themselves. And if we measure this move for the uptrend from the start of it to the finish, it's about a 13% move. Now, textbook would say that you enter your trade on the candle following the closing of the pattern when it's validated, so around right here. And then you would set your stop loss right above the third candle, or you would set your stop loss above the upward trend. So right around here. And if we measure the move from the candle that opens right after the pattern is validated, measure that to the low, we can see that that is about 16% move to the downside. All right, the last multi-candlestick pattern we're going to cover is the 3 white soldiers. It's a bullish pattern that appears during a downtrend and that traders use to identify potential trend reversals or the continuation of an existing uptrend. Now, as you can see here, it consists of having 3 consecutive long bullish candles, each with having a higher close than the candle before, indicating that the buying pressure is increasing and that the bears are out of the market. We also want to have the wicks be equal to or lesser than the size of the body of the candle, as we have here. Now I'm going to go over a trade setup for this pattern. For this 3 white soldier pattern setup, I am on the Bitcoin chart and I have the 1-week time frame pulled up. So these candles are very powerful. I've also laid out a demand zone here that's in green. First, I want to point out what looks like a potential 3 white soldier pattern, but it's invalidated because the first candle here is a Doji candle. And you can see that the wicks are considerably larger than the body, so that would invalidate it. Now, that in itself could be a good trade setup because we have the Doji candle, which we also know is a reversal pattern setup. There's aggressive buying that's occurring in the demand zone. So at this point in time, entering in a long or buy position here, there could be a point made for that. But at the third bullish candle, which would be the third candle of the assumed 3 white soldier pattern, that would not be a good trade to enter because, again, the first candle's body is considerably smaller than the wicks. Now to the right over here, we have 3 bullish candlesticks. We have the first one coming out of the demand zone with aggressive buying, and then we have the closing of each candle's body being larger than the candle before it. And all the wicks are smaller than the bodies. So this is definitely a three-way soldier pattern. If we play this out, we can see that price does continue moving forward. Alright, that finishes up lesson 1 for this course. If you appreciated this video, subscribe because I will be releasing more lessons for the rest of this course here on my channel. Also, comment below if you thought the Wojak memes were a good addition or not to this video. Thanks, guys.